Hey guys, how's it going? It's Andy from MagooInvesting. Pretty normal Monday, right? Maybe not. So in today's video, I normally don't make videos on Mondays just because I have stuff to do over the weekend with a lot of schoolwork, so I usually take Monday off. But because of the things that happened this past weekend and how the market reacted this morning, I wanted to make a video talking about kind of the important things to remember and kind of give some tips for people that are panicking about the stock market right now. There's a lot of media coverage about, oh, this is the worst day in the stock market since this hasn't happened since this date, and connecting it to different recessions and stuff. So in this video, I wanted to talk about the facts that caused the market reaction from today, talk about some things to remember in the future, and kind of give some tips to make it so you don't stress out as much about the current situation in the stock market and in the world overall. Before we get started, I gotta say that I'm not a licensed financial advisor and I highly recommend talking to professionals, someone that can find you the best places to put your money going forward. In addition, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. Basically, a lot of the problems that happened this morning comes as a result of it being a Monday. As I've talked about in the past, a lot of really volatile days in the market happen on Monday. And the reason behind that is because the futures market, which is the market that trades 24 hours a day, 5 days a week, is closed. And during that time, when it's closed, kind of the news events just start to pile up. During the week, if a news event happens, it moves the market immediately. And so traders are only available to trade on the overall market from 6:30 to 1 p.m. That's Pacific time. But the stock market is currently being moved by larger investors, and you can have some smaller people involved in it as well, but the futures market is always going during the week. So this weekend we had some big news events that came out, and when the market opened this morning, it fell hard. The stock market opened down 7%, and as a result, it halted the market. There's a bunch of different names for it. I know of it as a halt. There's a circuit breaker is another way to describe it, or a trading curb. And this is the first time this has happened in the stock market since 1997. And when it's been that long since that, that news just starts to spread pretty fast, because when things haven't happened in a while, especially when it's associated with a negative event, people panic really quickly. A halt or a trading curb or a circuit breaker is there to protect the market from news events that cause panic in the market. And this can go even if the stock is going to go up or down. And a halt, as I'll call it from now on, gets triggered when a stock moves 7% within a certain time frame, and it pauses the trading on that stock or the overall market for 15 minutes. And today was kind of unique. This is the first time that I've seen it personally where the overall market has completely halted. I've seen it on some companies like the weed stocks and some biotech. Usually happens when a big news event's about to drop, and they want to make sure that investors are able to see the information before kind of piling on the direction that the stock moves. And this is kind of what happened this morning. The stock market opened 7% low, gets triggered a circuit breaker, and the market just kind of had to wait there for a second. So why did the market react this way? There were two big news events this past weekend that resulted in this huge market move. And pretty much as has been the case with every video in the past month, coronavirus has been at the forefront of all this news. At this point, it does not seem like it's going away anytime soon. With 115,000 cases reported, some countries are having a really tough time, and a lot of countries like the United States are starting to get more overall exposure, which causes a lot of tension in the world markets, economies, and just the mindset of people across the planet. When the market's just in a complete sense of tension and anticipation, waiting for more news events to come out, that's never really a good sign for the market. The market does not like tension and uncertainty. One of the ways that you can see that is looking at the treasury yield, which is a way that you can use to gauge the overall investor sentiment towards the market. Treasury bonds, or T-bonds, are a contract that you can sign with the United States government for either 10 years, 30 years, and I think you can do some in between. Basically, it means that the rates or the yield is the amount of interest that they're willing to pay you to borrow money from you. And for people that are looking for very safe investments, yeah, this is like the safest you can get, because you're signing a contract with a certain rate that you'll get paid back at. So when the market's doing really well, rates go up, because why would you want to give your money to the United States government for a 2% return when on average a stock market goes up 9%? So when the market starts to fall and investor sentiment goes down, these yields tank. And we've seen this just in the past couple weeks. Just a couple weeks ago, at the end of February and early March, yields were sitting around 1.5%, and today they dropped down to 0.3%. They're down around 0.5 now, but you can just see how quickly investor sentiment has changed over the past couple weeks. And the big news that came out on, I think it was late Sunday night, had to come from OPEC, which is the Organization of Petroleum Exporting Countries. Basically, it's the countries that have the largest supply of petroleum and oil products in the world. And basically, they set up this organization to kind of set the price and production levels to make sure that the market is overall stable. And they met in Vienna on this past week, and they try to come up with a plan to cut production, which is what all of the countries involved, except for one, wanted to do, because as the coronavirus has started to spread, the demand for petroleum products has started to go down. So in order to keep the prices relatively stable or have them go up a little bit, they wanted to cut production. And one country, Russia, did not like that. So Russia did not like this plan, and they refused to sign the deal. So when you don't have a deal that goes through, some countries kind of took it upon themselves to create this into a price war. And the main country involved was Saudi Arabia. Saudi Arabia decided to get back at Russia for disagreeing to these terms, and as a result, they slashed their prices and increased their production. And as a result, if you have seen the markets overall today or just some major news stories, oil prices were down 25% because of this deliberate slash and these price wars that are about to ensue. From what I've read, Saudi Arabia appears to be doing this to try to take some of the market away from Russia and get them back into trade negotiations, because when there's not a deal signed, it doesn't make OPEC strong together, which is kind of the historical benefit of OPEC being together, is their unity together. At one point when I looked this morning, stuff was trending on Twitter that you could buy a 16-piece wing from KFC for more than it costs to buy a barrel of US crude, which is ridiculous to think about. Either KFC is really expensive or crude is really low, and I think it's a mix of the two. So these were the two main news events that pushed the market down. We talked about coronavirus creating uncertainty, and you have these tensions and conflict with OPEC, and market does not like that overall. And it was the mix of these two events that have pushed the market down so far. Okay, so let's cut it out with the bad news. Now let's talk about the future and what we can expect. If you went on social media at all today, stuff I saw was a lot of trending, hashtag Black Monday, hashtag market crash. And I wanted to talk about the 3 recognized Black Mondays and compare them to the one that we saw today. Because people have been calling it Black Monday, but let's compare it to the ones that are actually considered a Black Monday. So today the market fell 7% overall. Pretty tough day, right? But when we look at the first Black Monday of 1929, it does not look so bad. Black Monday of 1929, there was a 13% drop, which came immediately after a 11% drop on the Thursday and Friday of the week prior. And then the next day just happened to be Black Tuesday, which is the day that kicked off the Great Depression, where the market fell 23%. So yeah, that's probably the most extreme sense of a Black Monday, but let's talk about the other two. Black Monday of 1987, the stock market fell 23%, and it's considered one of the worst days in stock market history. 23% compared to 7%, I will happily take that 7% and kind of walk away from that one. But there's one more, Black Monday of 2015. On this day, the stock market fell 16% over concerns about global tension and a potential slowing of the Chinese economy. I feel like I've heard this before. It's almost like it happened in 2018 as well, and kind of what we're seeing right now. We've had some large reactions to the slowing of the world economy so far, but they don't really compare to the Black Mondays that we've seen in the past. I think we just need to stop retweeting things that have Black Monday or market crash in them, because it's causing people to panic for reasons that aren't really valid at this point. Yes, this is a huge drop, but compared to what we've seen in the past, this isn't that bad. So I know the word recession keeps getting thrown out. When people get worried about the overall market and the economy, recession is the thing that people automatically start thinking about. So I wanted to go back and talk about the past recessions and kind of how the stock market has reacted before it, during it, and after the recession, so people can have a better understanding of if the market or if the economy does fall and we do hit a recession, what that actually means for your investments going forward. So this graphic I'm going to put up right now, I think is probably the best tool that you can have to look at to kind of feel better about how the market's reacting right now. Basically, it's showing every recession since 1958, talking about the year prior to the recession, how the market moved during the recession, and the 1, 3, and 5 years after it. And as you can see, if you look at it, those are some really solid returns and should make you feel a little bit better about kind of the overall state of the market. 15, 40, and 79% for the 1 year, 3 year, and 5 year average returns after a recession. Those sound like pretty solid gains. So even though things look kind of gloomy right now, there are some better days ahead, and those are often when people make a lot of money. With the right mindset and planning, if you have cash on hand, Market pullbacks like this and recessions are great opportunities for people to make a lot of money. However, I would wait because at this point, all of the market movement has been a result of speculation and kind of companies coming out and talking about how they're worried that coronavirus is going to affect them for their outlook for the upcoming financial year. So it's been a lot of warnings and the news events that we're seeing. Until we start seeing economic data about how it's impacting the US economy and the overall world economy, I would not be making any moves in the stock market right now. We just don't have enough information about how much of an effect this coronavirus is having on the world. And then I wanted to finish this video by giving some tips for how to feel a little better if people are starting to feel kind of panicked about the market. This is a very emotional time. When you see these large percentages, this means people are losing a lot of money. And one of the number one tips that I've kind of learned over the years is to not obsessively check my portfolio. On days like today, when I know the market's down 7%, it's not going to help me at all to kind of look to see how my account did. It probably did very similar to the overall market. So kind of checking it when you know how the market has done doesn't really help you in any way. I used to obsess about how the market was affecting my overall portfolio, and I would obsessively check it like 15 times a day and kind of see how my money has moved over time. And I realized that that was really not healthy. So for a time like now where it's very emotional, people are starting to panic, if you can hold back and not check your portfolio for a while, I think that's probably the best option for people. I know people say this a lot, but if you can afford it, I highly recommend to stay in the market. From everything I've shown right now, it's looked like we're going to hit a rough patch for the upcoming months or even a year, but after that, we're going to have fantastic times in the market. However, when people hear that they should stay in the market, that doesn't mean for everyone. For someone that really needs the money, don't think of taking your money out of the stock market as being a horrible thing. 401k was trending on Twitter today as people were talking about checking their overall investments in their retirement portfolios. And based off of my analytics on my YouTube channel, 99% of people that are watching these videos shouldn't be touching those at all anyway. So don't be worrying about that. But for people that have stuff in more liquid accounts that they can sell and get the money out if they really need to, I highly recommend kind of understanding your overall emotions when it comes to finances, because I would highly recommend selling off your shares and getting some money into your pocket if you're starting to feel stressed about the potential of the future, or if you're just stressing out about kind of the market in general. People always say stay in the market at all costs, but I don't think all costs is the right thing. Just in January, I ended up selling all of my stuff in Acorns because I needed the cash, and I was feeling uncomfortable seeing the amount of money I had in my account. And me liquidating all my stuff in my Acorns account, I'm gonna have to pay taxes on that, but that's really the only loss that I had right there. And so for people that are seeing, oh, I've lost all this money in my account, that's not really a bad thing. For someone like myself that lost $800 day trading back in 2018, I can write this off of my taxes to kind of counteract a lot of the capital gains that I had in 2019. And so people, if you're taking a loss right now because you need the money on hand, it'll still benefit you in the future. It's not like that money that you're losing is just going away. Sure, you don't have access to the actual dollars and cents, but you can still see a benefit of that in the future. So taking your money out of the market isn't the worst thing in the world. All right, before I finish this video off, I wanted to kind of talk about the state of media right now. And I have one request, and that's to kind of double check all of this information that you're reading online before retweeting it or sharing. We're living in a time right now where there's been a lot of panic induced by false claims and stories going around that just straight up aren't true. So with how much panic we're seeing right now, I'd say be very safe about how you're sharing your media and how you're talking about this coronavirus, because most of the stuff we're seeing right now is a lot of panic based off of media interpretation and people passing along information. So until we really know everything about the current situation of the economy, the stock market, and coronavirus as a whole, I'd recommend to kind of stay away from sharing information that you see just one time and assuming everything's true, because there's a lot of information out there and not all of it has been fact-checked. So thanks for watching this video. I hope this made people feel a little bit better. We might be in for a long couple months or a year, but things will get better eventually. And the returns that I showed in the past recessions, things are going to be really good in the future. So hopefully people are staying optimistic and not getting too down after a horrible Monday, but hopefully everyone has a fantastic rest of the week. Maybe we can get some of these losses back tomorrow in the stock market, but we'll have to see. So thanks for watching this video, and I'll see you in the next episode.